It's exactly a year ago at the very same venue that we had kicked off the 2012 AIC, focusing on three fundamental issues affecting the world economy at that time. The turnaround in the US economic growth, and we focused on the housing and debt ceiling issues, and the obvious question of European outlook and growth, and the question of a turnaround in Chinese economic growth as it moved towards a once-in-a-decade political change. Our conference last year addressed these and other key issues. There were several takeaways which proved to be extremely insightful throughout 2012. And as you can see on the screen, we'll just show you some of the key takeaways, only 3 of them from last year. I'll just take a pause here for you to read it. So we had some really good key takeaways. Now the uncertainty of 2012 is now history. We have come a long way in the last 6 months. A US recovery is now underway. Europe seems to have drawn the line under the issue of the peripheral economies until obviously yesterday with Cyprus. And China never had a hard landing and a good political smooth transition. So with the sentiment improving significantly from the lows of the third quarter last year, the key question on everyone's mind, and I'm sure you'll agree, is this recovery sustainable? Or is it going to be what happened in the last so many years that we have a great start to the year and then things go south? So is the US housing recovery sustainable? Is having the S&P at a record high while unemployment is at 7.5% sustainable? Is Europe's worst behind us, or are we going to have a repeat of the last few years? Is China's leadership going to be able to balance between the need to grow against the possible risks of inflation? In the past few months, 4 or 5 months, another fourth element has come into play, Japan. Is the recovery in Japan sustainable? All of us who attended Prime Minister Abe-san's keynote speech at the AIC last year would recall the intensity and passion with which he wanted to bring about changes in Japan. He certainly hasn't disappointed the market since getting elected. So the question is this dawn in the land of the rising sun real and sustainable? So the theme for AIC this week, for the next 4 or 5 days, will be that whether the economic recovery is sustainable. So to kick off our opening session today, we will focus on this sustainability theme across US, Europe, and China. All 3 of our panelists this morning are highly distinguished economic advisors who have been instrumental in setting economic and market policies for the 3 largest economic blocs in the world, again, the US, China, and the European Union. If I could ask them actually to come to the stage, please welcome. So seated on my far right is Song Guoqing. Professor Song has been a faculty member at the National School of Development at Peking University since 1995, and currently a sitting member of the Monetary Policy Committee of the People's Bank of China since March 2012. He graduated from Peking University in 1982 and later worked towards his PhD at the Economics Department of University of Chicago. Welcome, Professor Song. Seated on the left of Professor Song is Lorenzo Binismagi. Mr. Binismagi is currently a visiting scholar at Harvard's Weatherhead Center for International Affairs and at the Institute of International Affairs in Rome. Mr. Binismagi began his career as an economist at the research department of Banca d'Italia in 1983 and subsequently became the head of the policy division of the European Monetary Institute in 1994. In 1998, he was appointed the Director General of International Affairs in the Italian Treasury. From June 2005 to December 2011, Mr. Binismagi served as a member of the Executive Board of the European Central Bank. And during that period, he also acted as the G7 and G20 Deputy for the Eurozone. Welcome, Mr. Binismagi. Last but not least, I would like to introduce Dr. Glenn Herbert, Dean of the Columbia Business School and former Chairman of the White House Council of Economic Advisors under George W. Bush administration. Dr. Herbert has been the Dean of the Columbia Business School since July 2004. Prior to becoming a full-time academic, he served in the US government as Deputy Assistant Secretary in the Treasury Department for Tax Policy from 1991 to 1993. From 2001 to 2003, he was chairman of the US Council of Economic Advisors and also chaired the Economic Policy Committee of the OECD. Welcome, Dr. Herbert. So we're going to start our panel session now. If you want to tweet your questions to us, you can tweet through this. You can email it to us as well, or we can ask, you can ask questions at the end of the discussion as well. What we will do is, over the next about 40 minutes, we will have a discussion on what we think is the sustainability of these three regions' economic recovery. And we will start by asking each of the participants questions about their area of specialty. So, for example, with Glenn, asking about the US, what he thinks about the US recovery, especially from a housing point of view, from a fiscal deficit point of view, and also if he has any views on the global growth as well, the connectivity with China, with the European Union as well. We'll do that for each of the participants for 5-6 minutes, and then we'll open it to a discussion. I must introduce Vincent Chan, sitting at the other end. He's our head of China and the chief strategist. He's our internal Chinese guru, along with Dong Tao, the two gurus we have actually for the last 15 years within CS as well. So if I can start with, Glenn, with you actually on the US about the housing, obviously recovery coming through, and what do you think is the sustainability of that and the fiscal deficit as well? How do you think things will shape up over the next 6 to 12 months?
Yeah, I think for the US, there's a couple of issues. One is about the forecast, and the other is about underlying economic narratives. On the forecast, the consensus is roughly something like 2% growth for this year. But what's more interesting than that are what could be upsides and downsides. Now, you identified a key upside in housing, and I would add autos to that, things that are more interest sensitive. Monetary policy is certainly beginning to have the positive effect it intended. There are also upsides if we had policy coming together for getting cash off the sideline, and a huge upside in the energy business in the United States. What are the downsides? Suppose the two teams in Washington can't play in the same sandbox. I think that's quite likely in the near term, and there's a real downside risk. And then obviously the Eurozone. In terms of narratives, there have been two tensions in the US. One is, let's do a series of short-term things and then hope that the long-term works. That's been the present administration's strategy. It hasn't worked terribly well in reviving economic growth. Another narrative says, well, why don't we try to get the long-term right? That's about fiscal consolidation, tax reform, better regulatory reform, and then unlock more certainty in the near term. And I think those two narratives are really playing out in Washington. Key risks in all that, as I see it, have to do with two kind of exits. One you asked about and the other you didn't. One is on fiscal policy. You know, there's a chance we could get a real deal with long-term spending restraint that could really, really unlock growth in the American economy. If we fail to do that and muddle through, I do worry about markets losing confidence. Monetary policy is also a real exit issue for the United States. I think growth will accelerate in the next couple of years, meaning the Fed's got an interesting problem. They would like to manage a soft landing with a little bit of financial repression, I think. I think that's very hard to do. And I think there's a real risk they wind up having to tighten faster than they think with bond market implications, or sit too passively for too long and unlock inflation expectations. So I think that's a real risk. The key global thing I'm worried about is politics. I worry about that in the United States for the reasons I said, but I also worry about it in the Eurozone, where we hear we need a banking union, and then all of a sudden Cyprus happens, and we can't get together for fiscal consolidation. Japan, a lot of good talk, but the Japanese need more than a new BOJ governor to fix the Japanese economy. And in China, a lot of good words from the new leadership, but a real question about whether the policies will match. So I think around the world, Politics is my biggest worry.
If you can move to the Eurozone, Lorenzo, if I can ask you the same question.
Well, the outlook looks much less bright from the Eurozone point of view. Basically, the adjustment is taking place, I mean, the fiscal adjustment is taking place at a faster pace in Europe, especially in Southern Europe. And this has a restrictive impact on the economy. On top of that, monetary policy is relatively restrictive to the extent that the OMT, which has been announced by the ECB last summer, applies only to those countries who request a program. And for reasons of pride or for other reasons, neither Italy nor Spain have applied for this program. So long-term rates remain very high in these two countries and make it more difficult for the economy to recover. On top of that, the banking system is in a phase of restructuring, so there is a credit crunch, basically, both in Italy and Spain, and this makes, again, the recovery much more complicated, and the adjustment, the fiscal adjustment, is into some kind of a loop by which, over the short term, you have increasing debt to GDP instead of a reduction. Structural reforms have been implemented, but some of these reforms are pro-cyclical in the short term. I have in mind those in Italy in particular, where it has been made easier to lay off workers, and of course in a recession companies are happy to lay off workers, but on the other hand it has been made a bit more complicated to hire new workers, and in a recession where you may need for those countries that are doing well, and some are doing well, those which are exporting, they can't hire as much as they would like to. So this is quite restrictive. Then you come to the political environment, and that is even more complicated, I guess, than in the US, because you have the element of pride I mentioned, so Italy and Spain wanting to go by themselves. But you have also an election in Germany in 6 months, and that makes it difficult for Europe to have nice deals. And we've seen with the Cyprus deal how complicated and how strange it has been. Basically, if you want to understand what happened, you should know that there is an election in Germany, and the problem with the opposition, the SPD, the Socialist Party, has always approved all the bailout packages in the past. And so they cannot really criticize the government for the European policy because they always voted for it. So this time around, they found a way, a reason not to vote at the package as it would have been managed according to previous lines, on the basis of the fact that there are bad banks involved, doing money laundering and strange things with Russia. So they insisted in having some kind of haircuts, including for depositors. And so for political reasons in Germany in particular, the haircut on depositors was imposed, also because there's not enough bonds to get a haircut on. So, and then domestically in Cyprus, the split between deposits below 100,000 euro and above 100,000 euro was again decided based on political reasons. The new government, which had just been elected, is a right-wing government, and they wanted eventually to protect some of their voters. So the politics of it makes it complicated. We may come back on some of these issues, and of course in Italy there's no government. So this will not help investment or consumption, so growth will be weaker than expected, and the structural reforms which had been implemented by the previous government, by Mr. Monti, are still to be in practice implemented, and more have to be done. So it's not a very bright picture. If you want to look for good news, you have Ireland. I think that's a bright spot. Of course, it's the opposite from Cyprus. It's so far away on the other side. It looks a different continent, but it is a part of the euro area. And it shows that, if you do your homework, slowly you're getting back to the market. And those who trusted in Ireland and invested in Ireland made a lot of money. So, the picture in the end is very diverse. But, and you have other bright spots like Germany. I mean, if you compare actually the German position in terms of GDP, it's actually better than the US compared to the pre-crisis level and compared to unemployment. So you have a strong part of Europe and a part which is recovering, and another part which is very sluggish. So the question you would ask, will it hold together? Maybe that's the question for the second round.
Please go ahead. Yeah.
No, so I will leave some...
For the second round as well, okay. I think there are at least 4 points we'll come back to actually, right? If we can move to China as well, Professor Song, if I can ask you the same question, especially with the political transition happening, there are a lot of questions about the restructuring or rebalancing of the economy from exports to domestic consumption, and also if you can talk a little bit about shadow banking as well, because that again has been a theme for 2 years. Vincent has been talking about it for 2 years, and it keeps on coming back.
谢谢。我还是讲中文吧。
I'm going to speak in Mandarin. I'm going to talk about 3 points. One is recently is economic development of China. Last year, in the first half of the year, was going down, and so later we could see there's a very strong recovery. And so now people worry whether the recovery is sustainable. So from what we can see, and so we're looking about inflation. In January and February, the CBS inflation is pretty high, but in March, according to current situation, it's going to go back to 2. So that means that there's no hurry to do any macro management. So I think it's 8.3 is GDP growth. And this is about the same as the market prediction, and so there is just some discrepancy. And so future situation, what I feel is on average the growth and is going down every year. So this year it's about 8.3, and in 5 years it's going to become 7%. And so next year it's going to go down. It's because of the supply of labors and the supply demand is going down. And so of course, so what I need to emphasize is the number of people is decreasing, but they are more educated, and people working in the cities, and they have more work experience. So I think that the labor resources, and so it's going to go up, and this is to compensate for the reduction in the number of working force. So I believe that what I can say that, and so this is about the same as what the mainstream prediction. So some are very pessimistic, and so there are going to be lots of problems. And so for now, so I have not seen any obvious situation like that, but there's still the risk. And that's one thing. Another thing, and so it's about people are all talking about, and in the past, so how many years, so investment is too high, and consumption is lacking, but in the future, import export also high, and the ratio to GDP, it's obviously has been reduced, and so now it has reduced to a very low level, and the main issue is domestic consumption and investment, and the whole world is saying that investment is too high and consumption is too low in China. So for that, number one, like what I've mentioned, is the growth issue. And so on average, the mainstream, on average, opinions are about the same. And I think that for this one, I'm opposite view. So I said that because in China, we can talk about 30 years ago, the investment, when it reached 30%, and in China, lots of economists, almost all economists said that investment in China was too high, so there are going to be problems very soon, and that would not work. And they said 40 is too high, and so there are lots of problems. Now is 50, and it's going to reach 60. I don't know, but and it will not be below 50. So that's what I think. And why is it like that? Because one is a very fundamental problem, and it's a savings rate of China, savings rate, and also the age factor, and also future developments. They're very much related, and we know that. in the 1950s and the 1960s, China, and so there's a high birth rate. Lots of children were born. So I was born in the 50s and the 70s, and so we had the one-child policy. That when they started is to control the growth of population, and this is to create worldwide, at least in major countries. That's something that had not happened in those major countries before. You can imagine 30 years later what's going to happen, and so something is not that extreme. It's a bit extreme, but not that extreme situation is, and a couple going to work, both go to work, and so they have 4 parents and 8 grandparents. And so any more more ancestors and under that circumstances, and this has not happened in any major countries in the world before. But the issue is a couple with 4 parents and 8 grandparents who are going to support them. So to support them when they become old. So that's an issue. One thing is, so future young generation to support future older generation. That's one resolution. And another thing is, a family going to work now, so they are safe and say they support themselves. So it's a very high savings rate. And so many people said that there's a problem actually in the world. If you think about simply speaking, and so this generation. And if they spend all of the money they make, and so in the next generation, how much taxes you have to raise in order to support the older generation, so you use taxation to support the next generation of the elderly people. So how high would the tax needs to be due? And if the tax is too high, and so this will be the money that you can get from taxation is going to be reduced, and people will leave China. They don't want to stay in China anymore because of the high taxation. And the thing is that what Japan is doing right now, and it's the government keep borrowing money, and so it has a very high, high debt. So of course, the United States is a bit different than Japan, the debt situation, and so Japan in China, the debt situation in Japan is really brought by the growing old aged population. So I think that in China this is a very dangerous situation, especially in China. It's as a large capital, and in the future, in the world, and there's going to be a very and so it is to borrow money outside, and so this is something that is unimaginable. So for this, I believe that China, so they talk about low consumption, high investment. So for that, it's maybe is the opposite. I think it's completely the opposite, because now we have statistics that show that the savings rate, how much a family saves. So for a family, their financial assets, so they're different, like the savings, the banks, and also other things, minus and the mortgage. And what is left behind equals to 2-year income, equals to 2-year of income. And this is actually level is not high at all when compared to the world. And so after you retire, 34 years support to retirement, that is completely not sufficient. So of course, what the China needs to do is something that we can discuss. That you can say you do this, I can see you do that. But the issue is currently people has to believe, and also to allow consumers is trying to believe in the future the government is going to support them when they get old. No one's going to believe that. And so they would definitely continue to save. So to continue a very high savings rate. So because this structure is a very realistic, a practical issue. So in the recent few years, and so in 3-5 years earlier, and it's a middle-sized family. if they're willing, they can hire 3 nannies. And so this is something unimaginable in other economies. So like a middle-range family, they can hire 3 nannies, but they only have 1 because the cost is very low. I think 30 years later, is it possible? Can 1 nanny, can they take care of 3 professors? Because at the time, young people, there are very few young people, so they would go to university and also to graduate school. These are these old people. So in hospitals, and so people take care of the people. So for now, so when 1 year of savings cannot support their 1 month of income. So you can imagine, you can think of this issue. So people say there is a bubble burst in the real estate market in China. So if I don't buy houses, what do I have other options? So buy US, and so if I buy RMB, it would not be able to beat inflation. And so from this angle, so completely from a savings point of view, so this is a so do you have no other choice? So of course, with this, so actually the government wants to do how to stimulate consumption. So it's almost there's no way to do that. And so no matter what we need to do, that is one issue. So from prediction point of view, in the few years, I don't think there are any other options but to continue to invest. So of course, so invest rate is a bit low, and so the growth will be a bit low on the low side for the ratio to GDP. So maybe it will be raised a little bit, and so I don't see any that's going to be reduced in the future. So in China, it would depend on investment, and so to get in and lift, so consumption it will keep the same about. So to increase consumption is difficult to do, and it cannot be done. And so because it will create other issues. And this is my second point. The third point is about China. So the Chinese government and the enterprises borrow a lot of money, and so the currency and GDP, the ratio is very high. So I'm going to talk about this very simply. And China in the international market, and it's a creditor country, so it loans money out. And so they talk about international, they borrow a lot of money. And so where are the creditors? Who are the biggest creditor? I don't see who has a lot of money to loan or to lend to other people. So what's going on? So like what we said, the family savings and the financial assets is not very high. The level is not high. So they have some mortgage. The mortgage, the level is also very low, and the savings also not high. So what's going on? So part of it is because enterprises versus enterprises. Me as a company, so I borrow money while I also save money in the bank at the same time. And so I'll buy bonds and I'll issue bonds on one hand, and on the other hand, so I will loan money out. And so it's very common. There are lots of such occurrences. And so we look at families' financial assets from that perspective. So this is not a big issue. But of course, what we need to pay attention to is future economic development is going to go down. And so the rate of is going to be a level. And so this is a big issue. So I don't see that. I don't agree with that. Thank you.
Oh, it's fascinating, actually, the way you talked about the short term, actually long term. We'll come back to that. Glenn, if it's okay, I think after this discussion, US seems to be in the best shape, so we'll not talk about US as much, actually. Lorenzo, if you can start with EU on if you especially on Italy, if you give us a little bit view on Italy itself, what do you think the political scenario is likely, how it's going to play out? Number one on that, and number two, obviously, if you have some, it's very topical about Cyprus, and how do you think it's going to develop?
Well, maybe starting from Cyprus, clearly the decision which has been made was, you had to have a haircut on deposits because there were not enough bonds. The split between less than 100 and more than 100 has been the result of a domestic political choice. So probably European authorities would not have preferred to hit the lowest, smallest depositors, but that was a choice, a domestic choice. They're actually trying to change it, as far as I understand it, because that's not politically very sound, but the new government didn't want to hurt too much of the large depositors, because I guess they still want to maintain Cyprus as a financial center, as an attractive financial center, and you don't do that if you start taxing depositors. Now, what will be the contagion? I think that's, there are two dimensions, I think. One is the psychological contagion from seeing people on television lining up for their cash. That's a very powerful contagion effect, and this may have an impact. Although, if people look at the situation from a rational point of view, the Cyprus situation is very different from the rest. But television really scares people, and not everybody knows how different Cyprus is from Italy or Spain or other peripheral countries. The other contagion, I think, is a market contagion to the extent that over the last 2-3 months, markets have been very quiet in spite of all the negative news which have come in Europe. Negative news in terms of lesser growth, the debt to GDP ratio stabilizing at a later date, the elections in Italy, I'll come back on that, no progress in France, probably the next few months in Germany without a lot of changes. So all these may lead, and the problem is in Spain, of course, should have led markets to start doubting about the stability. But they haven't really moved. They were waiting, markets were probably waiting some element, some trigger, and this could be the trigger for awakening markets again. So we will see over the next few weeks whether this will be a sufficient trigger. But my impression is that markets have been too complacent over the last few months. On the basis that the ECB would intervene sooner or later, but in order to intervene, you need for countries to apply for a program, as I said earlier, and that's where we get to Italy and Spain. Italy, the election created a situation by which basically the three parties have 30%, and in one of the two houses there's no possibility to have a majority. So the likely scenario is that they won't be able to form a lasting government, and we could go back to a vote within the next 6 months. And that's not a very stable scenario. The idea is that within the next 6 months to change the electoral system and to make a system which may lead to a more stable and more similar voting system in the two houses. Now they have a different one for the lower and the upper houses. I mean, the ideal situation to avoid having a stable government. So, but in order to do that, they will probably won't have time to take the important measures which are needed to continue the structural reform process. So the impact, the economic impact of this political stalemate is quite negative on the economy. And so this will be another point that financial markets may want to look at in terms of maybe getting nervous again about the stability of the euro area.
Okay. If you can move to Japan, into China, Professor Song, you talked about the short term, and if I can just get those data points you're talking about. So I think a couple of points you made, actually, the Jan-Feb inflation, especially the Feb inflation, actually made markets nervous. They were high, and you think that the March inflation will actually be coming down. And I think if I listened correctly, it was 2%. It will come down to 2%. So how confident you are, and what's that based on? If you can talk a little bit about that. Number two, you talked about that GDP this year you're comfortable with the 7%, and next year it probably can be lower than 7% or at 7%. Staying at 7%. So if you can just have some clarity on that. And the third one you highlighted, which again has been the theme, that the labor, the labor supply obviously is lower, and the point you were making was that the quantity can be lower, but the quality is going up. We are going up the productivity chain, so you're not as concerned about from a productivity point of view on the manufacturing side. So if you can just elaborate a little bit on these 3 points.
Okay.
Concerning March inflation, we can see that this is reflected in consumer goods. Almost on a daily basis, things are getting more expensive. So I think by the end of March, it will come to 2%. Actually, in the first 2 months, it was as high as 2.6%. Probably because in the previous winter, it was very cold. And after March, the winter effect diminishes. So I think inflation will be kept at around 2%, meaning that our fiscal policies can be a little bit more relaxed as long as we can sustain stable economic growth. So my prediction is GDP growth about 8.3%. But this is going to slow down to 7% in 5 years' time. In 10 years' time, even lower. So it is a dropping trend, but it is a gradually dropping trend. As for our labor force, we have seen a saturation. So we now focus on, instead of increasing the number of labor, enhancing the quality. We want to place more and more young people in our universities. Today, 60 to 70% of our youngsters are admitted into universities. In recent years, there are many workers coming into the cities. They come from villages. At the beginning, they have a very low wage level, and the productivity level is very low. Because when they first come to the big cities, they have a very low wage level. And gradually, they pick up some new skills, some new knowledge, and then the wage level can increase, and their efficiency also improves. In the past decade or so, about 100 million such villagers have come to cities to look for work. At the beginning, they made very limited contribution, but that has totally changed today. This is because of education, and also because of training offered to these workers. So I feel very optimistic. Yes, the quantity may be dropping, but I feel very optimistic because the quality of labor is improving. So concerning labor supply, these are my considerations. For the longer-term economic growth rate, I think I still remain optimistic. Of course, it's impossible to sustain 9% growth all the time. It's been coming down in recent years already. Between 2005 and 2006, the potential growth rate already peaked, more than 10%. The real growth was higher than 10%, but then there was inflation. Today, about 8.3%. This is normal potential growth. That is the situation. Thank you.
Song, if I can ask you a related question to that, actually is on, so if you think inflation is not going to be an issue, what do you think will be the next interest rate direction, and how soon do you think that can happen?
Right now, I do not see any interest rate hike or plans for any major macro adjustment or tightening. I think the biggest factor today is still inflation. Of course, there could be some fine-tuning here and there because of the control over credit and loans. That's been an ongoing effort by the government. And this is also because of changes to the reserve ratio at banks. But when it comes to adjustment of interest rate in the first half of this year, I don't think it is very likely to happen. Perhaps it will happen in the second half. I know that other people think that inflation rate this year is quite high. Actually, according to government documents, it should be kept at a level lower than 3.5%. So for the first half, perhaps only 3%. So for the second half, slightly higher. Whether there should be rate hike in the second half, it really depends on the actual situation. I think it's about 50-50 chance.
Okay. Glenn, coming back to the U.S., if you can talk a little bit about fiscal deficit, the balancing of the budget, actually, if you have any views on that, and if you think it's going to come to a head any time over the next 3 to 6 months.
Well, I think the interesting thing is it's going to come to a head repeatedly over the next several months and probably a couple of years. And the debate over the so-called fiscal cliff, I think, is just the beginning. The sequestration will have a relatively modest effect on the U.S. economy. The tax increases that we just saw will have a much larger headwind for the economy this year and next year. And so it really depends on which path we take. I'm encouraged to hear President Obama talk about corporate tax reform, because surely one of the best things the U.S. could do in the near term is to radically reduce the corporate tax rate and broaden the corporate tax base. There's a lot of consensus in Congress for that. I think that's probably the leading tax policy surprise that could happen. I'm concerned, though, on the spending side, because we have a political process that focused spending restraint where it wasn't needed, which was in the domestic discretionary part of the budget and not in the entitlements. I was struck hearing Professor Song of how different the U.S. and Chinese situation are. As a business school dean, I'm one of those nannies that supports multiple professors, so I guess I'm like a social security system in that regard. But for the U.S., we actually need a less generous social insurance system for many people. At the same time, China needs a more generous social insurance system. For the U.S., the question is, will our leaders confront the growth in Social Security and Medicare spending? And I'm not terrifically optimistic about that, and the result of that will be continued headbutting on the domestic discretionary budget. The reason all this is a problem is if you look at the debt to GDP ratio of the US, we are approaching a level where the estimates of people like Carmen Reinhart and Ken Rogoff would be that we could shave 0.5 percentage point off US GDP growth. Now, in an economy whose potential growth rate is only in the 2.5 to 3% range, why on earth would we do that? So, I mean, that's really the key fiscal risk.
Please.
I wanted to ask a question to Glenn. One of the interesting results from your poll is that, of course, Europe is the biggest concern. But there is another concern, which is the Fed tightening too soon. Now, there are two interpretations. First is that the Fed would not stick to its promise not to tighten. But then the second interpretation is that the economy turns out to be better, and then the Fed has to tighten. But if the economy starts getting better and the Fed tightens, why is this bad? Well, is this bad because this would shake up the pricing of many assets, which are predicated right now on zero interest rates, and may to some extent reveal that there is a bubble already? Isn't that what we draw from these answers, that there is already a bubble?
I think so. I mean, the big issue I have had with the follow-on rounds of quantitative easing, not the original making markets work, but the follow-on rounds, is that it's really distorting capital allocation massively. And that's not something the Fed is ignorant of. It's a bet that the Fed is taking that can exit exactly the right time. So I think about a simple decision tree for the economy. If growth stagnates, then we either have the Fed continuing to buy up all the bonds and Japanizing the American economy, or we have structural reform. Neither of those seems too likely. If we have growth accelerating, which is the scenario I mentioned, if the Fed could tighten exactly right, it could indicate a move toward a soft landing. But if the Fed somehow missed the timing, given the capital allocation that we now have, I do worry about a big bond market and risk asset reaction. And if the Fed sat passively, then I worry about inflationary expectations coming unhinged. So the way I interpreted this survey is probably people worrying about multiple branches of that tree, not necessarily just one.
Okay, if you can move back to China, think a little bit about the longer term, the one-child policy and the consequences of that, which obviously we saw the positives of that. Now we are looking at the potential downside of that. So what's the solution? Now you have a new political government, they have a 10-year mandate, and they will know this problem as well. How do we fix that problem?
I think right now, people going to work should save up the money. We should have a high deposit rate. I think we need to start saving. Other economists are saying, oh, people are saving too much. But their own saving is much bigger than mine because they are preparing for retirement. They don't have grandchildren. They only have one child. So we will only have 1/4 of a grandchild to share. So there's no other way. Right now, the saving rate is very high in our society. But it is a kind of investment. Domestically or internationally, we can make investments. There is a lot of reserve inside the government.
So for the domestic savings, so we can say that it's about housing and like an investment. So the simplest measure is about a house. So how do I cannot depend on my children when I get old, even if they very obey me a lot, they love me a lot, but they can't afford to take care of me. So even if they really love me or not really, they are filial piety or not, I cannot guarantee that. And so in old China, it's always the next generation supporting the older generation. This now is the opposite. It's the parents supporting the children. So we're supporting our children, and we can only depend on ourselves. And so there's nothing that's reliable. So what do you depend on? To depend on yourself is to buy a house. So it is to buy 2 properties. So one for you to live in, and the other one that you sell it upon retirement. So this is about a savings issue. So in society, if you buy houses, so when you get old, you sell it to the next generation. So it's not that you get taxes from the next generation. You use your houses in exchange for service. So that is a swap. But if you ask them for, try to get taxes from that, that's not reliable. So if the tax is too high, they'll run away. So now if you savings, you need to invest. There are no other ways. You continue to invest. So that's what I'm talking about. So China, high investment rate. So for now, I've not seen any. I think that can be changed. So last year, people said that the investment rate comes down a little bit. The final figure hasn't come out yet from the initial figures. And so consumption is up a little bit. Some people say it's a good thing, and so that kind of phenomena. But I think that this is just a short-term. It's a short-term change, and so there is no long-term significance in that. And so it's last year the GDP and the nominal GDP growth rate is 10%, but for personal income, is about the growth is 13%. So the enterprise profits is about 5-point-something%. And for 1 year, that's okay. 2 year, well, maybe, but 3 year, you cannot go on doing like this. And so this is a short-term thing. So it must be invested in the lower consumption rate. And so for the entire China's future. And 10 years later, I can't say it too clearly, but I think 10 years, and that's a very high investment rate. And so, but in here was the concern is environmental protection. So now everybody is very worried about pollution, and that's what can be done about what measures to do about that for pollution. So you have to pay a price, and so pollution and cost, you have to pay a price. And so who pays? Consumers. And so maybe government will use other measures to do that, but you have to do something about this. And another thing is investment. Investment, the return, the rate of return, what is it? So like what I have mentioned about savings, about investment. And so that means even if you give you a negative interest rate, and so because in the past 30 years, and on average, the interest rate is about 0. And so in the past few years is on the negative side. And even with that, you have no choice but to save because you have to support yourselves when you get old. And so the real rate of return of investment, like I say, is very high. So including, so for industrials, including real estate and the different kind of service, and so all these included, and I think it's about 7% or 8% of rate of return of investment, and so this is if you do savings rate is 0, but the other one is about 7-8%. So banks in China. And so they wanted to get your money, to grab your money. So that's what I'm seeing. And so maybe the situation might change a little bit. But on this aspect, so the profit is very wide, but it has to go down. If it goes down tremendously, you continue to invest. So I think that so many years ago, people have all been talking about, lots of people disagree. It doesn't matter. I won't say what you should do. So our prediction is if you can predict consumption of China will immediately increase, and so you have domestic consumption. Okay, our domestic consumption. How do you stimulate? How to stimulate consumption? To buy automobiles. But automobiles are traffic jam. So now on the first half of the year, you restrict people from buying vehicles. Second half, and you want to stimulate. So you're all confused. You don't know what you do. And so now, on the one hand, you restrict people from buying automobiles, and so you buy low emission vehicles. And low emission vehicles, yes, is efficient, but then you can't. So it can't move. So it can move when the light turns green. It won't move. So it's a very large traffic jam. So now China has a problem. What's the problem? And so if the whole world, so if they don't study economics, so if an alien look at the world, what should China do? China should build roads. It's very clear. But for economists, China should do consumption, consume. What's purchase vehicles is consumption, and so to invest. And so China, so it should produce vehicles, not to repair roads or to build roads. And so the roads is there are 5 people at home who has driver's license. We have 1 vehicle. I want to buy the second one. I couldn't do it. I don't have any way. What can I do? And so that's the situation. And so when you say that, everybody talk about consumption. And so this is completely, you have to look at it from a practical point of view. So the next few years, and so there are any other ways to build like subway, and so to continue to invest. And so the only way is to invest, and there are no other choices. And so this is so in the past 30 years, and so everybody, you have to stimulate consumption, and you have to control investment. In the past 10 years, you have heard people say that a lot. And so the State Council, you have to stimulate consumption. Then finally, they said in the first half year, and so one is first half you stimulate purchase vehicles. In the second half of the year, you restrict vehicle purchase. There are no other ways.
So no dramatic change from what the trend has been in the last 2-3 years. Okay. I need to go to Japan, right? So, and I want, I know this is not obviously your area of expertise, but what has happened in Japan in the last 4 or 5 months? If I can get your views from your perspective on what do you think Japan, whether it's going to be real, and I know, Glenn, you know Kroder-san quite well as well. And secondly, if yen goes to a 110, 120 type of a thing, can we get what, the famous term, the currency wars, or some reaction coming from some parts of the world if that starts to happen? Any views on that, Glenn, if I can start?
Well, I think there's 2 issues in your question. One on monetary policy. Of course, the Bank of Japan has pursued a policy that has allowed deflation to take root over a very long period of time. And a key issue for Kuroda-san is changing inflationary expectations in Japan. The prime minister himself has focused on that. Very unusual for a very senior government official to take such an interest in that. But I think that while Kuroda-san will be very effective, I think he will work hard to change the BOJ's targets. That's really not going to completely change Japan. Japan has deep structural problems that aren't simply about the rate of bond buying by the Bank of Japan. So I think one really has to look further in Abenomics than the appointment of Mr. Kuroda, as talented as he is. In some sense, he will be, I think, a very radical change at the bank.
Okay. And currency wars?
Well, you know, again, we're all doing it, right? So the U.S. is having a massive quantitative easing. It's happening in Europe, it's happening in Japan. I don't see it so much as a currency war per se as just, you know, each country trying to find the right answer, much as your question on the screen suggests the difficulty of exit.
Lorenzo?
Well, I think I fully agree. It's easy to pass the ball on the only game in town, and the only game in town is simply taking away the pressure on politicians. So it's nice to have a central bank who tries to do all that it can, but the problems in Japan, as you said, are much more different, much more complicated, and Abe will not just simply get away with trying to have more inflation. This will not solve Japan's problem. In terms of currency wars, I mean, the war is not taking place because there is a race to the bottom or a race to getting more liquidity into the system. So basically, if the dollar exchange rate goes up, then they revise the forecast about growth and they do another QE. Then if the dollar goes down, now the ECB says we will take the exchange rate into account, so maybe it's an addition. But where does all this lead us to? It leads us to an increase in liquidity overall in the system, which, in my view, justifies one of the concerns that were raised in the questionnaire, that central banks may start to tighten too soon. Too soon meaning independently of what happens in the economy.
Lorenzo, if I can interrupt you, actually we are referring to the question. The question actually is that with growth returning to trend, how will global central bankers manage higher interest rates, and how long can we stay at this current level?
See, I don't think they'll do it well. And it's not about tools. Every major central bank head is talking about tools. The issue is timing. And history is unkind to the notion that central banks always get the turning points right. Arthur Burns had all the tools at his disposal that he needed. He simply got the timing disastrously wrong. So I think for the reasons that I mentioned, I'm skeptical that this exit is going to be very elegant at all.
I think we saw, 2 weeks ago, there were rumors from the Fed minutes that maybe they would stop. And immediately you saw a reaction in the markets, and immediately there was a reassurance by the Fed saying no, no, no. So the risk is that there is a race to reassure markets, which may prolong and delay the tightening. So often central banks don't get the timing right because they don't want to hurt the markets. And the more you wait, the more you will have to tighten. But if you tighten, you hurt the market, and so you are led to delay. And this is what happened in '94, those who remember. And this time might be even much, much bigger, because the kind of liquidity that you have in the system is so huge that the simple expectation of a start of a tightening would lead to a major repricing of risk, and that would be quite hard.
And if I might, it's not just markets, it's politics. So think of the US. The budget problems are very bad with essentially zero interest rates. Now assume we had a normal term structure of interest rates, and what would the budget look like? And how would the US Congress feel about the Fed's unwinding its MBS portfolio? So it's not just the markets. The Fed is having to reassure political audiences as well.
Okay. Professor Song, about Japan and also about the yen, you know.
可是你
货币现状的问题。
So what I can say is because now in China, the biggest worry is because China holds a lot of U.S. debt. So if the United States continues to do the QE and with a high inflation rate, and China, and so the currency is depreciated, so it's a big problem to China. So China is like a piece of meat already on the chopping board, and U.S. would chop it, so it can cut how much, however it wants. And who asked you and to do and because 10 years ago I already said that you did this, so you like a piece of meat and you let them chop you whenever they want it. But there's no other way. So other things can be done now. And so now, so if I don't have that, that's okay. So if I don't have so much reserves, so the U.S. and so you spend U.S. So I appreciate my currency, so that something like that would not happen. And so I do not believe in currency war. And so you issue currency, so I can appreciate. If I want to appreciate currency. If I don't, I don't. So that has not a big impact. But the main thing is, and so sometimes that has already existed. And so when we talk about that in China, well, not in front of Americans. So what are you going to do about? So what are you going to do there? Are you going to fight them? You can't fight them. Who asked you to do that in the first place? And so there's nothing to be done. And so this is what. So morally speaking, there's nothing like morally speaking.
Okay. Glenn, I don't know whether you want to respond to that. We have a few minutes
I'll take
for
that
questions.
analogy home with me. That's a good.
Exactly. We have a few minutes for one or two questions actually. So Glenn, but did you want to respond to that, or you want to use that analogy going forward?
I'll borrow the analogy.
Okay. Professor Song, if I can ask one more question, actually, right? With the new political government now, and we'll take a question now after that, but 10-year view, this one-child policy, which was a big positive 30 years ago, is now becoming an issue. Do you think China is ready to revisit that?
Many people want to change that policy. And only the officials responsible for launching that policy still object. The others want to abandon it. But should we do it in one go, or should we do it gradually? That is the question. But of course, if we allow people to have more children, it's too rushed. We have to first get married, right? And then we wait 2 years, and then we can have a baby, and then another one. So it's too rushed.
Okay. It's not if, it's when, actually, then. Okay. Any questions from the audience? We have a question. Okay, there's a question there.
This is for either Dr. Herbert or Mr. Binismagi. So you mentioned these difficulties about withdrawing from quantitative easing. I wonder what you think might be the best historical parallel for another country or another situation to use as an analog for what the U.S. will go through when they try and exit this easing.
Well, that's a good question. I can't think of a parallel on the scale, which is what has me so nervous about the exit and the timing. I outlined for you the decision tree, which is all the possible branches, and many of them had risks on it. Only a few, the regular landing and financial repression, which I think is probably what the Fed really wants. Those are the only two that looked easy. The rest were hard. I don't know of a historical parallel that's of this scale. And the fact that you have such a change in capital allocation and such a change in market expectations, I think it's going to be very, very difficult. For Lorenzo.
No, and if you look at the last two cycles, the '94 tightening, which started and after the big shock was postponed and was done at a much slower pace, we ended up with the bubble, with the high-tech bubble. And the most recent one, which was also started too late and went up at a pace which was predictable but too slow, then led us to this bubble. So it's not only a question of exiting at the right time is to maintain the pace which is sufficient to reabsorb all the excess liquidity, and that's going to be very, very difficult, I think. So the issue is not inflation, goods and price inflation. We are going to see the next burst of the bubble before inflation picks up. I think that's the biggest challenge for central banks, and the illusion that we have now macro instruments, macro-prudential instruments, I think is an illusion, to be frank.
I agree.
Okay, great. I'm afraid we should stop here. It was a great discussion. We have a series of other sessions coming through as well. Please enjoy the rest of the week, actually, and please join me in thanking the panelists for a great discussion.